Welcome to It's the Economy. It's GDP season. Later this week, the GDP for the March-June quarter will be announced, rather the April-June quarter, by the NSO. But before we get to the GDP numbers, Citi India has put out an interesting report. The team led by economist Samiran Chakraborty has studied the first quarter results of 3,500 companies, and they conclude that growth of wage costs have fallen a bit in Q1 from a year ago, but it is still strong. However, what's not working is jobs growth. It's pathetic, as revealed by the Naukri Jobspeak Index and other indexes. So now what does all this mean for urban consumption and hence for GDP growth this year? Joining us is the man himself, Samiran Chakraborty, Chief India Economist at Citi. Good morning, Samiran. Thank you very much for your time. Well, first, give us this wage picture. You say it's still strong, although not as good as last year.
Thanks, Latha. I mean, there are different ways to look at this particular data, but let me first put it up that there is no official urban wage growth data, so we kind of proxy it by looking at the wage cost of companies. And by its very definition, this wage cost involves both change in nominal wages as well as change in employment. So the numbers I'm going to talk about, they're a combination of the two. And it's very difficult to differentiate between the two in a quarterly data. So giving this backdrop, I think what we are witnessing is that there is a slight year-over-year moderation in the wage cost of companies to about 13% from about 13.8% in the quarter before. But if you look at sequentially quarter over quarter, then the momentum has actually been better than what the historical trends would suggest. Typically, the first quarter is a weaker quarter for wage growth, but this year we have seen the quarter-on-quarter momentum also at 2.8%, which is quite strong. And in terms of qualitative nature of this data, what we find is that there is a more decline in the growth in service sector, but manufacturing sector actually wage cost growth has improved. And we find that the K-shaped recovery that has been the pattern still continues with larger companies reporting a higher wage growth compared to MSMEs.
Oh, okay. Well, Samiran, clearly what we got from the companies in terms of anecdotal, we don't look at wage cost when we look at the Q1 results and the interviews. But clearly, software services was terrible. I mean, the extent to which they were paying people in 21 and 22 were far higher, the rate of growth of their wage bill, compared to what it was in 23. So I'm surprised you're saying it is still strong, the wage growth.
Yeah, I mean, we obviously look at 22 subsectors of the economy. So software is just one of them. And software clearly is showing a decline in terms of year-over-year growth, but it's still not a negative number according to our data. But when you look at something like a Naukri Job Index, there it does come out that the sector is facing challenges. When you look at the software service exports data, there also there is some sense of moderation. So broadly, the narrative is correct. It's just that to the degree that we catch it in the wage data, that seems to be somewhat smaller compared to that being seen in the other kinds of data.
Oh, you can actually add media along with software services in terms of wage growth. But be that as it may, I think the point you're driving at is that wage growth is not that much to complain about. It's strong in manufacturing, as you say. But job growth is another story altogether. It's bad. Why do you see that?
So there are different ways to look at it again. So one, we discussed the Naukri Jobspeak Index where there is a decline. But if you look at the more hard data from EPFO, CMIE, etc., the EPFO data is still showing a year-over-year decline in the net additions. Although there has been a somewhat sequential improvement in the data, but the year-over-year number is still negative. And if you look at the CMI data, the increase in urban jobs compared to post-COVID is still just about 5% after almost 3 years. And within that also, qualitatively, what we find somewhat disturbing is that the manufacturing jobs are still 12% below pre-COVID. Whereas the somewhat comforting nature is that finally the salaried jobs have started improving within that urban job classification, and we are seeing it just inching up ahead of the pre-COVID levels. But overall, seems to be more pressure on job growth compared to what the wage data would suggest.
Okay. Now, that's Naukri Jobspeak clearly very bad is the job scene, according to them. CMI, it is higher, 5%, but much lower than pre-COVID growth. And thirdly, EPFO is still falling, the number of entrants, right?
Yes, that's true. Year over year, it's a decline. Sequentially, there has been a slight improvement. But I must say that the EPFO data needs to be seen with a 3-4 month lag, because the numbers get revised quite substantially over the will get revised over the next 3-4 months, because
we are comparing
exist better.
We are comparing like to like year ago, so I guess that gets ironed out. But that's a poor job scene. Now, what does all this mean for consumption? If wages are growing, but jobs are not?
So, in fact, I must say that the wage cost data that we are tracking is actually a combination of both wages and employment. So, in some sense, that tracks the consumption much better, which is why we are seeing that in our index through which we track urban consumption versus rural consumption. Urban consumption is clearly ahead of rural consumption for some time now. And we would expect this trend to continue. It's just that we are building in a little bit more cautiousness in that picture, because the employment growth in some of the sectors might be slowing down a bit, which can, going forward, affect urban consumption. Plus the fact that the excess savings of the pandemic by now would probably have got mostly spent out. So that tailwind will also be going out. But on the other hand, the asset markets are doing slightly better. So there could be a bit better wealth effect helping the overall consumption. So we're putting out some amount of cautiousness on urban consumption coming from the employment side and the excess savings side, but still would expect that urban stays ahead of rural for the time being.
What about rural itself? Your report, of course, was entirely an urban report. Are rural wages better? And what about this wayward and erratic monsoon, too much and too little, a disastrous combine? Is that going to mean that rural consumption will remain weak? What's your hunch?
So the thing is that the rural wages data for the period that we have got the data is still showing that real rural wage growth is negative right now. In fact, real rural wages have been kind of stagnant for a very long time now. On top of it, while it's a good thing that we've seen some increase in food prices, maybe it feeds into farm income with a lag. But at the same time, the policy making has become very complex, with the fiscal authorities trying to control inflation through different kinds of checks and balances. That might mean that the full terms of trade improvement for the farmers might not take place. And that could become an additional headwind for the farming sector. But still, in the very short term, we would expect some positivity from food prices to flow in to rural demand. We are seeing a bit of that already in things like tractor demand picking up. But the problem now is that the monsoon for August, which might turn out to be the driest August ever, could have some bearing on the next crop cycle, although the water reservoir levels are better. But still, there is a risk that this flows on to the next season, which could be somewhat more challenging for the rural.
Okay, then let me quickly wind up with what all this means to the current GDP. Your study is Q1 GDP, Q1 results of companies. So, does Q1 GDP get impacted? A CNBC-TV18 poll gave us a number of 7.9%. Is that a good number, or is this all base effect?
So, we are slightly ahead of that number. We think that the first quarter could be 8.3%. But this is a very, very peculiar quarter to forecast. There are not only complicated base effects to deal with, but also peculiarities in terms of how the GDP deflators will get captured. So the long and short of it to me is that there is no significant slowdown in momentum in the activity indicators, the high frequency activity indicators. But the GDP data might not fully reflect it when we look at this kind of 8% plus GDP growth also in a sequential sense. The decline in GDP will actually be more than what you would normally expect in the first quarter. First quarter is always a weaker GDP quarter. But even then, with our 8.3% GDP growth, it's about a 7% Q-on-Q decline in the GDP, which normally is half that number. So it's a complicated GDP data to interpret, but to me, the high frequency data is suggesting that there is no significant softness in the economy.
Okay, we'll have to leave it at that. Samiran, thank you very much indeed for joining us with your very interesting study of the wage cost, which is positive, but job growth, which has been very mediocre in the quarter gone by. The net for GDP, an 8% GDP or 7.9 as our poll indicates, but the negative that is the Q1 output is going to be far less than Q4. It is always less, but this time it's going to be particularly accentuated compared to pre-COVID years. That's something we should keep in mind. Let's not get carried away by the 8% number as and when it is announced. We wrap up on Bazaar on that note. Chartbusters up for you next.